Welcome back to the Fire Grind. On this channel, we talk about personal finance, and in today's episode, I'll be talking about my Wealthsimple portfolio again. However, unlike my previous video, 28 stocks in my Wealthsimple portfolio, I'll be actually going over a portion of the portfolio and revealing my cost basis for each stock, and I'll be focusing on the dividend paying stocks in this video. The other half of the video will be posted later on this week, where I go over more of the growth companies in my portfolio, so you can check that out when it comes later on in the week, so subscribe for that update. If you're looking to trade with Wealthsimple Trade, there's a link in the description down below that will get you $5 for free if you sign up with Wealthsimple today and deposit $100 and trade $100. Also, if you think the stock market's a little bit overvalued right now and you just want a safe place to stick your cash, EQ Bank currently has a deal as well. If you sign up today and deposit $100, you can get $20 for free. And EQ Bank offers the best interest rates in Canada right now at a 2% interest rate on the regular savings account. So now how we're going to be laying out the content for this video is that I'll be going over each individual stock. I'll be talking about the forward dividend yield, the payout ratio, and the frequency of payments, followed by the dividend growth for most of the companies that I could find information on. After that, I'll be talking about my cost basis, how many shares I own, and the current price today, so you can see whether I'm up or down on my position and by how much. And lastly, I'll be talking about if I'm going to be continuing buying these stocks going forward or if I plan to sell them. So the first sector we're going to look into is the utility sector. So I bought into this sector because it's an essential service to run our everyday lives in our homes. Things like electricity, gas, and natural gas are things that we need in order to survive. So the first company I have here is ALTA Gas, which is a natural gas provider mainly. And in 2002, they started paying dividends. So that was roughly 18 years ago. So they have a pretty good history of paying out dividends. Their growth, though, on the other hand, is not that great because recently they've actually had a negative 13.87% growth in the dividend. And that's over a 5-year period. And if you look back 5 years ago, you can see why. However, if you also look at the stock price has heavily declined as well with the dividend. And this is because they got into a bit of trouble, I think, with debt, having too much debt on the balance sheet, and people were selling the stock off. And also ALTA Gas had to cut their dividend in order to pay their debts. I currently own about 10 shares, and I paid $20.76 per share. And the current price is $14.78. However, they have a P ratio of 9.75. The forward yield is around 6.1%, and the dividend is paid monthly. They also have a payout ratio of 64%, which is a healthy payout ratio as they have around 36% that they use to put back into the business. And I still think they have a bit more room to increase the dividend at a payout ratio of 64%. My plan for the company, as I only own around 10 shares right now, is to continue buying it going forward. And I think that I won't be buying in the immediate short term because my opinion right now is that there is going to be a second stock market crash, but I will be looking for an attractive price in the future if the market does drop. The second stock in my portfolio I'll be talking about is Inter Pipeline. So Inter Pipeline has been paying their dividends since 2002 from my research. And with the pandemic, the dividend was actually cut recently. It was growing at around a 5.65% rate over the past 5 years. However, now that growth has been basically evaporated because they cut their dividend. The payout ratio is around 134% according to Yahoo Finance, which is a little bit sketchy. And my cost basis for the stock was $21.76, and I have 20 shares currently in my portfolio. The current share price is $12.61, so it's roughly half since I bought it. And they have a P ratio of 9.8. So my strategy going forward for Inter Pipeline is to hold these shares until the price goes back up to about even, and then I'll liquidate the shares. Because personally, I don't really believe in the oil industry, and therefore that's why I'm considering selling these stocks, but I don't really want to sell at a loss right now. And with it paying a monthly dividend, I'll just keep raking in the dividends until the stock price returns to around what I bought it for. And I don't think this business is going to go away because Inter Pipeline actually operates on contracts. So these oil companies, they buy contracts from Inter Pipeline, and Inter Pipeline usually has these contracts for like 5 to 10 years. So they actually have a steady stream of income, and therefore I think they're going to be able to sustain their dividend even though they cut it. Next, I'll be talking about some hydro companies in my portfolio, and these hydro companies I'm fairly bullish on just with the whole trend of electric cars and electrification of our society. Electric cars definitely will bring a huge boost in the whole need for hydro. Therefore, I think hydro will do well in the long term, especially as consumers catch on to electric cars and it becomes more of a norm. So my first stock in the hydro segment is Hydro One. And this is a hydro company that operates predominantly in the GTA. And they started paying a dividend since their IPO, which was in 2015. The forward dividend yield is 3.88% and they pay this out quarterly. And they have a dividend growth rate of around 3 to 5% in the past 5 years. And they have a payout ratio of around 69.5%, which is fairly healthy for a utilities company. My cost basis for these shares is around $23.88 and I have 10 shares in my portfolio currently. The price currently though is $26.68 and the PE ratio is 19.14. And I think the PE ratio is a little bit higher right now, even though there's this whole pandemic happening and the stock market has dropped. I think that they're able to maintain this higher PE ratio because electricity is essential to everyone's life. Unlike natural gas, not as many people use natural gas, or maybe people are weaning off oil, but electricity is very essential just for running our lights, our appliances, and other things in our homes. For me, I'll continue buying Hydro One going in the future, and I think I'll be buying around the $25 to $26 mark. Right now, I'm still a bit low on cash, but as I continue to pump cash into my portfolio, I will be adding more shares of Hydro One. And the one thing that I really like about Hydro One is the fact that they service GTA area. GTA is a growing space because a lot of young people just want to move closer to the city. So I think that GTA is going to continue to expand in population and Hydro One will be able to capture on that. The next utility company I'll be talking about is Algonquin Power and Utilities Corp. They started paying a dividend in 2013 and this dividend has been growing at 5.61% year over year over the past 5 years. The payout ratio is 93.5%, which is quite significant. Because that doesn't leave them much cash to play with to put back into the business. However, Algonquin Power has actually been growing rapidly if you look at their stock price. And I think the reason why their payout ratio is high right now is because they're actually incurring a lot of expenses by growing their business. Once they flip the switch and actually turn into more of a dividend stable profit company, they will definitely have a lower payout ratio. But the fact that they're expanding right now into the renewables energy sector especially, I think that the payout ratio is going to remain a little bit higher. The forward dividend yield for this company is around 4.41% and it's paid out quarterly. And my outlook for this company, I think is fairly positive. I will continue buying shares in Algonquin Power just because they're tackling the renewable energy sector and that's a huge tailwind for the business. Society as a whole is trying to shift towards renewable energies because people are taking notice of the environmental impact of the non-renewable sector. Now, Algonquin Power Corp is one of the first movers in this industry. The next utilities company is Fortis, and they've been paying their dividends since 1989. So this is roughly 31 years or so that they've been paying a dividend. And they have a 5-year growth rate of 3.37. People say this is one of the safest companies that you can buy on the TSX today. And this is one of the reasons why I bought into the stock. They have a payout ratio of 50%, which is significantly less than Hydro One and Algonquin Power Corp. And they have a 3.58% forward dividend yield, and they pay out quarterly. I bought my shares at an average price of $52.66, and I currently own about 10 shares. And the current price of the stock is $53.01. And they have a PE ratio of 14.16. So you can see that PE ratio is lower than Algonquin Power Corp's. And that's because Fortis is a bit more of a stable company, not geared to growth as much because they are quite large already. I'll continue buying this stock in the future because they have a low payout ratio, which means they're able to continue increasing their dividend. My price target for buying the stock is actually roughly around where I purchased the shares for, the $52 mark. The next sector we're going to talk about is REITs. And REITs require a payout ratio of 90% if you guys didn't know that. So I won't really be talking about the growth because they basically pay out the dividends based off of their income for that quarter or for that year. So first stock in the REIT sector that I own is Sienna Senior Living. And I have a cost basis of $18.27. I own 50 shares and the current price is $9.55. Ouch. I basically lost 50% so far on this position. However, the reason why I bought into this REIT, as well as the next one I'm going to talk about, is because they own retirement facilities. And I'm bullish on this in the long run because I know that baby boomers right now in their 60s, they're actually going to be the ones entering their retirement homes in the next 10 years. And this is a huge tailwind for retirement homes. So currently, Sienna Senior Living has a forward dividend yield of 9.51%, and they pay monthly. They have a dividend growth rate of negative 2.99%, and I think this is over roughly a 5-year period. And this might just be the nature of them trying to build up more properties and not being able to pay out as much. However, I think that eventually this dividend growth rate will turn positive as more and more people enter these retirement homes. They have a payout ratio according to Yahoo Finance of 1,550%. But this is actually an incorrect way of valuing REITs because it's not based off of the net income. It should be based off of their free cash flow. And on the income statement of their Q1 2020, Sienna Senior Living reports their payout ratio based on their free cash flow. It's actually the term AFFO, which I'll show on the screen right here what it means. It's around 61.3%. So that's a relatively healthy payout ratio. The next REIT that I own that's also in the retirement sector is Chartwell Retirement Residences. They have a forward dividend yield of 7.19%, and they also pay out monthly. So if you're a fan of monthly paychecks, REITs are kind of the space to play into. They currently have a negative 3.24% growth rate over the past 5 years. However, that doesn't really worry me. I'm just looking more for the stable monthly income. And I know that in the end, they're going to be able to grow their dividend rate at a positive percentage rate as more and more people enter these senior homes. There was actually a couple residences built near me, and that's kind of a sign to me that they're continuing to increase the number of buildings that they operate. These buildings cost them some money, and therefore their growth rate of the dividend might actually decline in the short term because they need to fund these buildings. They currently have a payout ratio of 56.6% according to the latest earnings report. And I have a cost basis of $13.62 over 60 shares. However, the price today is $8.18. So you can grab both these REITs for quite a steal in my opinion today. And the next REIT I own is Canadian Apartment Properties. In this REIT, they basically buy up apartment buildings in urban cities. And one of the major cities that they buy properties in is Toronto. And I believe that the Toronto market, although it's a little bit slow right now, it's going to pick up, especially when this pandemic's over. Everyone wants to get into the city, especially those that are young, and investors are actually looking to buy properties in the city for the purpose of renting out to younger people who are trying to move to the city and can't afford these $500,000 apartments. They have a forward dividend yield of 2.92%, and they pay out monthly. This REIT has a dividend yield a bit on the lower end because the price, if you look at the charts, has shot up in the past 5 years. And this is with the whole rise of real estate in the Toronto area, especially in 2016 when there was a huge boom in Canadian real estate market. They have a dividend growth rate of negative 0.38% over 5 years, so basically the dividend's been fairly flat over the past 5 years. However, I think this is due to the rising cost of real estate, so this REIT is actually paying a bit more to acquire apartment buildings or build their own. But as they start to operate these for the long run, I think the rent prices will continue to go up slowly, and this company is actually poised for continuing growth in the dividend. The payout ratio is 20.8%, which is also another sign that they're able to increase their dividend. But I think right now the strategy for the company is to deploy more cash into purchasing more buildings, as the real estate market is not going to dry up anytime soon in Toronto. I have a cost basis of $52.57, and I currently own about 2 shares. I'm actually looking to purchase more shares as the current price is around $46.94. So it's actually trending a bit lower just because people are uncertain about what the real estate market's going to be like, especially for residential areas. But one thing that's sure is the Canadian population is going to continue to grow. And when people move from other countries to Canada, most of them are actually moving from places like Asia where there's large city populations. So these immigrants are going to want to move into the more urban areas rather than out in the country. So I think the real estate market is going to still be good for the next 10 years in these large urban areas within Canada. The next stock that I own in the REIT sector is Brookfield Property Partners, ticker symbol BPY. And they currently have a forward dividend yield of 12.52%, which is stellar, and they pay out quarterly. They have a 5.71% dividend growth rate over the past 5 years, and their payout ratio is 122.45% according to Yahoo Finance. However, according to their financial reports, their payout ratio based on their cash flow is 27.47%. And this is more meaningful to this REIT specifically, because really you're really looking for a company that has good cash flows, and the fact that their payout ratio is so low, I'm sure they're going to be able to weather this pandemic, as a lot of their clients are actually in the retail space and also commercial real estate. So those companies, although some of them might fold, BPY actually reported a 90% plus payment from their current tenants. I have a cost basis of $24.50 and I own about 30 shares. The current price for this stock is 14.22, so you can grab these shares for steal at a forward dividend yield of 12.52%. I am interested in purchasing more shares of BPY, however I'm going to be holding off currently because the pandemic presents a lot of uncertainty for commercial real estate. The last REIT that I own is Slate Office Real Estate Investment Trust. This one I bought a little bit more on a whim, showing their dividend yield being around 10% when I bought it. However, they cut that dividend quite quickly after I bought it. And the stock actually dropped from around $6 to $5, and today it's around $3. They primarily operate in the office real estate market, and we know that a lot of people are working from home right now, and we don't know if companies are actually going to go back to working in an office. So there's quite a bit of uncertainty around the office real estate market, and this is what's driving the stock price lower these days. The price to book ratio, however, for this company is 0.4, which is one thing that I really want to highlight, because essentially if they sold all their properties today, they could recuperate roughly 60% more than what their current stock value is. So I think this is a good reason why I'm going to continue holding onto the stock, because of the low price to book ratio. They have a forward dividend yield of 10.8%, which is fairly large, and they pay out monthly, which is also nice. And they have a payout ratio of 73.2%, which is actually not too bad, because even if some of their clients aren't able to pay their dividends, they still have a bit more margin and able to pay out a bit more. My cost basis for these shares is 5.96%, and I own about 110 shares, and the current price is 3.61, so you can actually grab these shares for a steal. The next sector of my dividend paying companies is the transportation and logistics sector. In this sector, I own one company, and this is TFI International, which I actually made a video on before. If you're interested in checking that out, you can click the link right up here. So TFI International, they've actually been paying a dividend since 2003, according to this website. They have a growth rate of 8.87% according to my calculations, based off of the dividend 5 years ago compared to today's dividend. The forward yield of this dividend is around 2.46%, and TFI International actually pays a dividend quarterly. The payout ratio for this company is 25%, which means they actually have a lot of room to grow the dividend. They could even double their dividend yield and actually just have a payout ratio of 50%, and that would mean they have a forward dividend yield of about 5%. The cost basis for my shares is $42.58, and I currently own 2 shares. And currently the price, if you're to buy TFI International today, is $41.70, and they have a PE ratio of 10.8. So this is a fairly low PE ratio for this company, and I think it's fairly valued actually. And the dividend yields being around 2% still has a lot of room to grow, seeing as the payout ratio is also very low as well. I will continue to purchase TFI International, and roughly around the $42 mark is where I'm looking to continue to purchase shares as I deposit more money into this account. The last sector that I have dividend paying companies in is in the finance sector. And the first company in this sector is Manulife, and they've been paying the dividend according to my research since the year 2000. They have a 5-year dividend growth rate of 7.79%. They have a forward dividend yield of 6.46%, and it's paid quarterly, as well as the payout ratio right now is 44.4% of their income. So this is a fairly healthy payout ratio as we've seen before. It's under 50%, and even with this whole downturn in the economy, Manulife, I believe, will still be able to keep paying out the dividend without needing to cut it. Currently, I own about 40 shares in this company, and my cost basis is $21.96. And the current price, if you were to buy Manulife today, is $17.10. They have a PE ratio of 7.34 with this current price, which in my opinion is actually a very attractive price if you're looking to start a position in Manulife. For me, I will continue buying this company as it is a stable insurance company in Canada, actually one of the top 2, them and Sun Life. So I think Manulife is actually positioned well as a dividend paying company in this portfolio and will continue generating cash flow year over year. The last company we're going to talk about is Laurentian Bank, and they've been paying their dividends since 1995, and they have a 5-year dividend growth rate of 1.25%. However, that actually came to an end recently as they cut the dividend from around 67 cents to 40 cents. So we're actually going to see a negative growth rate if we continue forward in the future. They have a forward dividend yield of 5.56%, and if you go to Yahoo Finance, you'll actually see they have a forward dividend yield of 8.56%. However, this has not been updated for the recent dividend cut. So I did this calculation myself based off of the full year's dividend yield divided by the stock price. They have a payout ratio of 74% in the total trailing 12 months. And my cost basis for these shares is $42.71 on the 4 shares that I own. If you were to pick up Laurentian Bank today, you could pick up the shares for $28.44, and they have a P ratio based on the current price of 7.95, which is actually, again, quite low for a bank. Typically, the banks are maybe in around the 10 to 13 P ratios. So if you're looking for a cheap bank to pick up, Laurentian Bank is that. However, just to warn you, Laurentian Bank is one of the more riskier banks out there right now, as they are a smaller market cap and I believe they deal in more riskier investments. So beware if you were to buy Laurentian Bank, it's possible to continue seeing the stock drop further. For me, I'm looking for a exit point for Laurentian Bank just because I don't know too much about the business. And when I bought in around the $42 mark, and I saw the stock actually drop from around $60 to $40 or so, and I was hoping for a recovery play. However, I just held on too long and this whole pandemic hit, and the stock just got cut in half again pretty much. So that about wraps it for this video. Smash that thumbs up button if you enjoyed this content and got some value out of it to understand where I bought my stocks and as well as what price I'm willing to pay for them. As well as click the subscribe button if you haven't done so yet, because I'll be releasing another video on the other half of my portfolio, which is mainly growth stocks. So you can hear my thoughts on those stocks, my cost basis, and whether I'm buying more of these or selling those stocks going forward. And leave a comment down below if you have any questions or just want to start up a conversation. I'd be happy to answer any questions that you have on my portfolio and why I'm doing certain things. Keep up the grind and have a great day.